Hey everybody, welcome to the morning market briefing. It's Tuesday, April 18th, 2023. Hope you're doing well out there. Futures up a little bit across the board. Dow futures up 13, S&P up 43 basis points, NASDAQ futures up 72. Kind of a mixed bag though of actual news to discuss. Let's open up with JB Hunt. Stocks down about 2%, and they're calling it we are in a freight recession.
Yeah, I mean it's pretty bad, and it was bad in terms of the volume in intermodal. So what they do, they people see the JB Hunt trucks and they say, "Oh, it's a trucking company." It's not a trucking company. It's a freight company. And so what they do, 50% of their revenue and more than that of their profit comes from intermodal. And so basically drayage, so taking containers from ships to rail and really helping that machine work and really being pretty integrated in the supply chain. So that's really what JB Hunt is. They do have a trucking business that is just getting clobbered right now. I mean, it's down about 22% on a year-over-year basis. But even their intermodal business, which is a little bit more sticky and retains profit a little bit better, declined throughout the quarters, down 2% in January, down 4% in February, down 8% in March. And they said that they're approaching a very, very difficult comp in the second quarter. So I think it's going to get worse before it gets better. They say they're in a deflationary price pressure in an industry that continues to fight inflationary cost pressures. So basically they're between a rock and a hard place. One interesting thing that I would note is that there was a discrepancy between Eastern volumes and Transcontinental. Transcontinental was down 9%. Eastern volumes were actually up 1%. And they said that the import market is just dead. We just aren't getting any imports in because there isn't demand there. And they also said, and this is very notable, and I think it'll be really illuminating when we get to some more earnings reports, because executives will come on and they'll be confident and they'll say, we understand what the consumer is doing. But JB Hunt, who is shipping for these customers, says they have no idea what's going on. Their bid compliance, they were complaining about it when it was in the 60 and 70% range. It is now below 60s, in the mid 50s. They said it's terrible. It's an all-time worse, which isn't good English, but it basically speaks to their exasperation. And they say that at this point, our customers have been less accurate than ever before. So basically, they have no idea what they're going to do. The customers, so think like your Targets of the world, your Walmarts of the world, your Home Depots of the world. All these customers have no idea what they're going to do because they don't have any good idea on the consumer. The consumer is extremely fickle. And I think that that's going to just create more and more uncertainty as the year progresses.
Do you think there's still some hangover effect for that, for a company like JBHT, where they're seeing customers who are still kind of working through just inventory concerns and maybe still kind of saying, hey, we're going to need a lot. We're going to need a lot just to be safe?
I think there's an element of that. But I think that has pretty much died out by this point. And if anything, you probably want to look to your like your transports, like a JB Hunt, as a leading indicator of the cycle. Historically, volume leads price, and volume is kind of, when volume starts to bottom, that's your kind of bottom indicator of recession. And if we're going the wrong way, if we're still on the decline curve on that, then you would probably at this point expect that we're a little bit earlier in that bottoming cycle than we might have thought beforehand. So I think we're more on the front edge of the recession than the middle and coming out of it.
You think that we should be watching the ISM manufacturing orders in order to determine whether or not to continue to hold JB Hunt?
Yeah, I mean, I think ISM new orders is a prime example, prime reason for why JB Hunt is doing so bad. I bet if you correlated, and we probably should do this, if you correlated JB Hunt revenue, intermodal revenue, with ISM new orders over time, I bet you would see a very significant positive correlation. And as we've talked about, ISM manufacturing surveys and ISM new orders are not going in the right direction.
This is a follow-up question, not really related to the first question, but do you think this is the most successful company started by a husband and wife with the same first name?
It's definitely up there.
People forget it's founded by Johnny and John L.
And it's a relatively new company.
Yeah.
I think it's only 40 years old,
Yeah, it's
40,
the
50
most
years old.
Arkansas thing of all time to have a husband and wife, both named John, starting a trucking company.
Very Arkansas. Pig suey.
Yeah.
Bank of America and other financials are reporting as well. Bank of America up 2%. Pretty nice quarter. Obviously, we've talked about banks specifically through the context of some of the smaller and regional banks a lot over the last couple of months. But really solid performance across the board for Bank of America. Does that bring any comfort, do you think, to the financial sector as a whole?
I mean, I think this was the best quarter of all the banks, by a fairly wide margin. I mean, even their trading business up 29% year over year. That was better than JP Morgan and Citi, which were about flat. What's also interesting is this Bank of America reported before Goldman. We'll talk about Goldman in a minute, but talk about a tale of two cities. But deposits were only down about 1%. They were down 6% last quarter. They had a lot of deposit flows come in at the end of the quarter. And right now on their assets, they're getting about 2.9% yield, which is pretty good. It's not as good as JP Morgan, but their deposit cost is just so low. People are really not moving their accounts from Bank of America right now. They're just keeping them there or even giving them more money, actually. So Bank of America is in a pretty good position really across its business lines.
This commentary really says it all. We delivered earnings of 94 cents per share, up 18% over a year ago in an economy with modestly slower GDP growth. So despite some of these headwinds, we feel like we're executing well. Goldman Sachs, on the other hand, down 3.5%. They just seem to be struggling to figure out what they're trying to do.
So I would give them a little bit of credit. They took a big haircut on Marcus and really de-emphasized. So this is their retail bank where they take deposits and give loans, which ironically, I feel like right now with this new Apple Card proposal, I think there's a good opportunity for them, but they're going the opposite direction. So it is what it is. At least they're trying to get back to their knitting. So they took a big loss. So like all these other companies that we were talking about with these hold to maturity and available for sale, Goldman had a portfolio of these. They actually sold some of those securities and the rest they moved to available for sale. So you lock in a loss on those securities that you sell, on those loans that you sell. And with the remainder, you mark those to market. So you're taking a haircut on your balance sheet on that. But their capital ratios are still pretty good. So I'm not too concerned about that. What I am concerned about is their core business. The fixed income, currency, and commodity business was absolutely abysmal. They had a brief stint there last year where I thought that FIC was really coming back for them, but they were down 17% this time. Again, Bank of America was up 20. Bank of America was up 29%. The others were flat, and Goldman was down 17. And they really blamed it on currencies and commodities. And I get it. Q1 last year was a really tough comp on that with the whole Russia issues and oil going crazy and people wanting to hedge and Goldman being the best vendor there. But man, I would have hoped they would have done better on the FIC this quarter, but they didn't, and their stock is down as a result. But I'm hopeful and I'm optimistic that we'll see a little bit of an improvement on the strategic direction and a little bit of humble pie from their executive team on the conference call. And unfortunately, I agree. I ultimately think that they need to take DJ. So David Solomon, CEO
slash DJ,
is a DJ. And he goes by the name of DJ D-Sol. So sometimes I let it slip. And
not even DJ. A good DJ.
He's not, no. And
shout out to our former intern, DJ Couchfire.
Yeah, I mean, if Tom was a DJ and his name was DJ T Russ, it'd be like,
yeah, man, DJ so and so. That's my DJ name.
And I'm just thinking to myself, we need to get Hank Paulson. We need to get John Corzine. We need them to take the DJ out and say, you're not doing this anymore. You're gone. And we're getting someone in here who can actually run this bank. And the fact of the matter is Blankfein didn't do a very good job either. I was looking at the returns from him from 2012 to 2019, and they were underperforming the market by 40%. So they've gone away from the business. They need someone who can actually make a call and can lead this company the way it used to be. And because right now it's not that.
Yeah, being the CEO of Goldman Sachs used to make you a rock star within the financial world and not within the actual electronic music world, and they need to figure that out.
Yeah.
Also, the fixed income thing, I mentioned this briefly to Ben after reading it, is I worry that they got too far into the structured notes business when interest rates were very low and they lost their core competency on just regular bonds. Because there's a period of time where they were reaching out to us and said, hey, do you want us to create some sort of bond for you, whether it be Bitcoin backed or linked to SPAC movements? I mean, it was just like the craziest stuff, and they can make a fortune on that because they, buy the assets, package them, mark them up. They'll probably make 3-4% on any bond they sell to you doing that. But when interest rates rise, suddenly what comes into vogue is just regular bonds, corporates, munis, treasuries. And I think that they shut down a lot of those desks. They lost a lot of that core competency and fired a lot of that brain power. And now they're getting zero interest in these structured notes, which are very profitable, but nobody wants them now because no one needs to reach for yield. And I think they've left themselves a little bit out on an island.
And I think it brings up a great question, Thomas. Okay, well, we're ragging on them and saying that they're hollowing out their business and not as good at their core competencies as they used to. So why do we own the stock? Because we do own Goldman Sachs across portfolios. And there are a couple of reasons for that. Number one, relatively attractive valuation. I mean, when we value the company, we get $370 a share. It trades now at about $330. And number two is I think there's a very good rationale that there will be some change, strategic change or management change in the next year. And I think that this is too powerful of a franchise. The assets are too good and the stock is too attractive not to have some catalyst happen to it. And so it's not the financial portfolio. It's a part of the financial portfolio. And frankly, it's actually held up pretty well this year, despite all of the banking issues. And I think it's probably outperformed some of the other banks. So that's why we hold Goldman, and it's going to be down about 3 or 4% today. But good things tend to happen in cheap stocks.
There we go. Johnson & Johnson up about 1.2%. Earnings per share came in at 268. Expectation was 252. Decent numbers on revenue. Just seeing normalization kind of across their whole business in terms of volume. Any major takeaways for you, Ben?
Yeah, I mean, they really benefited from some one-timers. COVID sales helped a little bit. I would call it about 50-50. There was a little bit of an improvement on the core business relative to expectations, and there was also a benefit of one-timers. So you had more COVID sales than expected. You had a really strong cough and cold season, which allowed like more sales of Tylenol and that sort of thing. And you had on the medical device side, you had a normalization in procedure volume, as you mentioned, which is probably a little bit one-time in nature, but still the franchises are performing well. Darzalex on oncology is performing very well. And I think overall they're setting themselves up well for that spinoff that's taking place later this year.
Lockheed also up about 2%, decent numbers on earnings, revenue, not a whole lot of chatter as it relates to the supply chain, which has certainly been a thorn in their side. Probably bodes well for others, not just solely for them. And they did reiterate their guidance. So decent day there for Lockheed, a stock that they make me so nervous every time they report.
Yeah. You just never know what's quite going to happen with them. But it was about as boring a quarter as you could get with them. And at least over the last couple of years, that's a good thing.
Yeah. Boring is good. And we'll wrap it up with just data from the fund manager survey. Very bearish, most bearish we've seen this year. What are you seeing in terms of positioning?
People are very overweight bonds and or actually have been buying bonds and staples and utilities, and they're in all those markets. At the same time, they continue to be sellers of energy, sellers of banks. And Bank of America analysts, they basically came out on the report and said, if we do not have a recession beginning in Q2, then you could just have a really big short squeeze, essentially, as people are very underweight equities. They also said that the pain trade is for higher interest rates. So that could really cause some issues in banks. And I do think that, we're kind of in between a rock and a hard place on that still, because if we don't have a tightening of financial conditions and recessionary conditions, the Fed has said they're going to have to raise interest rates more. And I do think that creates a concern, more of a concern with the banks. So for me, it's difficult to see a way out of this. And you had the JB Hunt news earlier. So I'm actually saying that the fund managers may actually be right here. But you always have to know where the weight is. And sometimes it may behoove you to just go to the other side of the boat.
Yep. It shifts quick. Shifts very quickly.
I mean, I think from an allocation of capital standpoint, bonds are extremely attractive right here. And it makes sense if you're going to be buying something, at least you know how much money you're going to make and in what time period. Right now, I think the reason for being underweight equities is because the question is how much money are you going to make and in what time period on stocks. In the long term, I'm sure it's an unbelievable trade. In the short term, things could get very choppy if we do head into a recession here in the second half.
One last thing to note, and Tom, this is be notable for you. A couple things. Number one is, if you saw the announcement, Apple Savings gives you 4.15% on your savings if you open an Apple Savings account. So that might be something to consider. Right now, though, we're seeing 5.25% in terms of rates that you can get if you lock your money up in treasuries for 3 to 6 months. And it's not even a lockup, but this is the highest, this is a cycle high in terms of those rates, I believe.
Well, it was a similar high, but it was further out, if that makes sense. So yeah, we could have locked in at exactly 5 to 2 years for 3 or 4 days earlier this year. But in terms of very short term interest rates, yeah, in the last week, we've seen a big sell off in anticipation of a new rate hike.
We're seeing that again this morning.
Yeah. So you can buy August. That August treasury right now is yielding you closer to 5.25% right now, which is just an unbelievable deal. I mean, the same bond was yielding 4.70 3 weeks ago.
We're seeing it in money markets too. I mean, I guess we're just advocating don't sit in literal cash right now.
Yeah.
I mean, the Schwab SWVXX is up to 4.68. The snacks, which is for large deposits into a money market, 4.83 on that.
And I mean, it helps you in two ways too, because number one, you're getting your money worked for you in a risk-free way, and number two, you're protecting the money from yourself and making sure you don't spend it. Because sometimes when that's in your checking account, you just go through it. When you actually put it aside like that, it forces that discipline on you, which it can be good, especially in these times.
Yep. All right, we'll wrap it up there. We'll be back tomorrow. Hope you guys have a great day. Talk to you soon.